Okay, peeps, welcome back. So today we're going to be talking about the call debit spreads and how this is another way to make money on crypto without having actual exposure to crypto. So with that being said, let's get it. All right, so we got the weekly chart up here on CLSK, the Bollinger Bands, all the different indicators. I'm going to get back to this in a minute. Okay, so what I actually want to do first is I want to go over here to Robinhood so you guys can see what these are. So you guys are probably wondering what exactly is a call debit spread. So basically what a call debit spread is, okay, so let's break this down. A call is usually a bullish, well, technically call is bearish, but usually um, when you have a call like a covered call or a long call or a call debit spread, usually theoretically you believe that the price will go up in order for you to make money, okay? And the reason it's called a call is because when your shares are called away from you, that's the reason why it's called a call, because your shares will get called away from you. Like with a covered call, you have the shares. So if it goes above your strike price, your shares will get called away, ideally at a profit. And the inverse is true with a put. With a put, it depends on the strategy, of course, but a put, generally speaking, is a bearish bet on the market. Usually you expect with a put that the price will go down below a certain price in order for you to make money, whether it's a long put, a cash secured put, or a put debit spread. There's also credit spreads, but we're not going to talk about that. We're not going to talk about those in this video. So the debit piece of it is basically you're paying money on a directional bet. It'd be no different than a long call, but because you're buying a call and selling a call on this, it makes it finances a piece of the trade to make it a little bit more affordable for most people to be able to take this trade. So the debit basically indicates a payment in order to take the trade, okay, whereas a credit would indicate money received in order to take the trade. Like when you do a covered call or a cash secured put, usually, typically speaking, you get a credit or you get paid options premiums to take the trade. That's an example of a credit. Okay, we're doing the opposite here. This is a debit. And the spread indicates basically the difference in price between the two strike prices, because when you do a call debit spread, it is a spread. Okay, there are two different strike prices. Two different strike prices, and we'll get into that in a minute, but basically it's on the same expiration. So I'm going to go over CLSK here. Okay, we can go into trade options. And again, we're doing this. There's always a risk of an early assignment or early exercise. If you guys don't know what that means, go look it up for yourself. I can't give financial advice, and I'm not going to. But what I will tell y'all is, if I were just getting into this again, okay, and not knowing anything about it, I would not mess with any of these debit spreads unless I understood what I'm getting myself into, because it could be very risky if you don't know what you're doing. Okay. So let's go ahead and get into CLSK. All right. So basically, I want to put on a call debit spread, but I want to pick a realistic price here that I think the price could go to. And basically it would hit my max profit and I could get out for maximum profit on this trade. So there's a lot of price action basically between this $15 to $20 area. So I'll pick somewhere in the middle, like maybe 16 to 17, somewhere in there. I think that's probably a good area to pick. Again, the price is at that macro support line, as you guys can see in this kind of microphone pattern here. It did hit it once before back here and had gone up ever since. So that tells me potentially this could be a strong indication of a bottom. It is also at the bottom of the Bollinger Bands, outside of the Bollinger Bands. And usually when it gets outside of the bottom of the Bollinger Bands, that usually indicates that it is going to probably likely move immediately upwards. Not a guarantee that it moves up. It could keep going down, but usually that's what happens. You can see it got above the top of the bull end of the band here and immediately came back down, got above it, then it came back down. So it doesn't always happen immediately. Sometimes it takes a few weeks, but that's part of the reason why I would be putting my contract expiration out towards the end of the year. The other thing we know about crypto is likely Bitcoin's going to go to new all-time highs right around November, December of this year, sometime after the elections. That's usually what happens, okay? So if Bitcoin goes up, the Bitcoin miners, Litecoin, Bitcoin Cash, Coinbase, MicroStrategy, those are all Bitcoin oscillators. Those are probably going to go up too. So we know that, well, I should say we know that crypto and Bitcoin likely are going to go up after the elections. We know that the miners could likely go somewhere between 15 to 20. It could go much, much higher than that, but we're going to say mid range 15 to 20. And we know that we want to have our expiration out far enough to where we can close early without risk of early assignment. Again, I never intend to allow these to expire. It doesn't matter if they're in profit or not. Generally speaking, we would always want to take our positions off the table, either at a profit or a loss, probably a week or two before expiration, just so there's no risk of assignment there. So, anyways, let's take a look at the different strike prices here. So basically, what we would do is we would buy a call and then sell a call at a higher strike price for the same expiration date. Okay, this is on the same expiration date. So I got my buy call here at 16, sell call at 17. So basically, the spread portion is basically the price difference between the two strikes, which, as you guys can see in this case, is 20 cents, or 20 cents times 100 shares, because each contract is worth 100 shares, would then become $20. Okay, roughly about $20. So we're looking at the profit and loss graph here, 15 to make 85. Okay, so that is roughly about a 5x. Yeah, it's roughly about a 5x. So the other thing I'd be looking at here as well is the open interest, just to see how many contracts get traded. Okay, very high volatility. That's always good. That means the higher the volatility, the more likely it is to hit the strike price. The delta doesn't, in my opinion, doesn't really matter so much in this situation. Maybe it does, but not really as significantly as with like a covered call or cash secured put. So this strike price here has 2,300. So in terms of liquidity and open interest, we're beyond good at this point for this particular set of strikes. So again, everything is lined up here nicely. So, you could theoretically take one contract, 5 contracts, 10 contracts. Again, this is kind of like a bet. This is not an investment. Okay, this is not an investment. This is not for passive income. This is not for the crypto bull run. If you're holding a position for a year or a year and a half, and you think it's going to go to $1 billion and you're going to get 1,000x, this is not what that's for. Okay, this is basically this is a strategy I would use if I was betting on earnings. Okay. But in this case, because the crypto bull run is likely to happen towards the end of the year, could also use this as a strategy to make money into that time frame as well. So we hold some native crypto. We have some MSTY, Coney, some of the miners. Those are probably going to all go up. We could also use this as another way to bet, a different strategy to bet, to be able to make more money on the crypto space going into the bull run. Okay. So 10 contracts, basically paying $150. Again, this is a debit spread to potentially make $850. If I wanted to be more risky about it, I could say maybe risk $500 here to make $2,500. So you guys can see the maximum risk here, max potential loss here is $450, but the maximum profit is $2,550. So the break-even price here is $16.15. Okay. So $16.15 is basically the difference between the two spreads, which would actually be 20 cents. But because Robinhood, you have to go, you would have to go a little bit more towards the ask price here. So you can see the 15 cents up here in the limit price box. That indicates why that would end up being $16.15. Okay, and anything beyond that break even is profit. So eventually it hits max profit at 17 and beyond. The difference between this and let's say a long call, like a leaps option of some kind, like a long leaps call, is with just a straight out long call, the upside potential is unlimited. Okay, it's limitless. As long as it keeps going up, well above and beyond $17, there is more and more and more money to be made. With this particular strategy, the profit is capped above the top strike price here, but it also makes it more affordable to take the trade, and there's also less risk. So, on one contract, I'll show you guys this actually. So on one contract of this, basically, I would be risking $15 to make $85. Okay. So the upside is capped, but the risk is also capped. Now, if I were just to go for like a long call, let's say, for example, I wanted to go a year out. Well, it's not quite a year, but we'll just say July 2025. Okay. Same strike price, $17. Okay. Lots of open interest. But in this case, it would actually have to go. You guys can see that because the bid here is so substantial, it'd probably get filled somewhere in between the middle of these two prices. But because the bid's so substantial, this thing would actually have a break even of $20.10. So the break even on the call debit spread is much lower. It's much easier to hit profit than it is with a long call. But then again, if CLSK just goes up into infinity, there is the possibility to make unlimited money. Again, I don't think CLSK is going to go up to like $500 a share. Okay. I see the cap probably being somewhere to 2030, but that's just to give you guys an example. So you can do this with any of the miners. If I was going to do it, I would do it with the bigger miners, the ones that have more liquidity. Because again, when you do a call debit spread, you need to be able to get filled on both ends of the trade. Okay. So when we open the trade, we need to get filled. And when we close the trade, assuming that we don't want to hold till expiration, which in our case, we're not going to hold till expiration because it's risky and we just don't want to do it. Make sure the open interest is good. If I was going to do a call debit spread, I'd be looking for probably at least 1,000, 2,000 in open interest per strike price. But you can see same thing here, 31 to make 69. So, you could put up as much or as little money as you want to. You could also do kind of more at the money. That's a way to get a safer, higher probability of potential profit. Instead of basically the further out in price you go from the current market price, the lower the probability becomes that this thing ends in profit. But if you're doing something like at the money, then it could potentially increase the potential to make profit here. So 34 all the way up to 66, so roughly about a 2x. Again, I'm not recommending anybody do this. I'm just showing you guys what I would do. You can do what you want, okay? So, there's CLSK, Mara, maybe Hut 8 would be a good one too. Again, it depends on the open interest. You could do this on Coinbase. Coinbase is another option, although I would not be, me personally, I don't intend to do any call debit spreads on any of these crypto related plays, probably after, I would say no later than Q1 of next year. So if I were just to assume, let's say that Coinbase could go up to $250 a share, which I think is more than possible. Again, this one's a little bit more expensive because 100 shares of Coinbase is valued at about $18,000, but you can see 165 to potentially make 835. And again, I would want to go out towards the end of the year because after elections, theoretically, the crypto bull market should start. MicroStrategy would be much more expensive right now, but as you guys know, they had a stock split, so it's a little bit cheaper as of right now. But kind of same thing, if you don't necessarily want to have exposure to crypto and the risk of owning crypto and, the government trying to ban crypto or whatever stupid thing they're trying to do this week. And you don't want to have to worry about self-custody and dealing with the bank and all that kind of stuff because it is complicated to be in the native crypto space. This is one way to get exposure to making profits without actually having to own any actual crypto. The Grayscale Trust is another option because, again, you can buy it on a traditional exchange. You don't need to actually go onto something like Coinbase to do it. So, MicroStrategy kind of bobbing in between these zones. I'd be looking at basically on a technical level, I'd be looking at somewhere between 170 to 200, maybe by the end of the year. Maybe it goes higher than that. It's hard to say. So maybe I'll put the strike price maybe 170, kind of at the bottom of that resistance, 170 to roughly about 172. Again, that is quite a bit higher than the current strike price. Okay. Hold on a second. Let me see if there's more volume at it. Okay, we'll do this one, 168 to 170, because again, we want to have some decent open interest here. Otherwise, if there's no liquidity, it may be very difficult to get out of the trade. If you want to close for profit early, actually, that's an arbitrage. I don't know why it's showing up like that. Let's try a different one. So this one and this one. Okay, yeah, these are, I don't know what the heck is going on here. All right, let's maybe try the 160 area. We'll go a little bit lower here. So um, maybe 160 to 162. Yeah, there we go. Okay, so 73 to make 127. So you can see the open interest is pretty good. Again, if I was doing a call debit spreads, like let's say I was going to put $1,000 into these bets, me personally, I would probably split it up into four different positions. I would have like two or three going into earnings on traditional stocks, and then one or two in the crypto space going into the end of the year. I'm just telling you guys what I would do, but you can do what you want to do. So 7 contracts, risking $500 here to potentially make 900. And then, MicroStrategy, this thing could go up $20, $30 in a single day. It's possible. As you guys can see here, this thing in 1 week went from 105 all the way up to 140 nearly. So it's a $35 move in a single week. Again, from right here, 122 to 158. Of course, the best bet for a long, in my opinion, based on technicals here, would be to get in at this green zone. But even still, it could go from 131 all the way up to about 170 pretty quick. I think maybe 4 weeks, 4 or 6 weeks, something like that is probably more than enough time for it to make that move. So anyways, this is another way for you guys to be able to make money on crypto if it's something you want to do. If not, then, I get it. There's already a lot of things going on that we're talking about already. So most people like it simple. They're just simple dividend investors, or all they do is covered calls and cash secured puts. I totally understand that. So anyways, hope you all enjoyed this content. Please like, comment, and subscribe, and I'll see y'all later. Peace.